Preparing for a risk analyst at PZU interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a risk analyst at PZU? PZU appeals to me because it combines a major insurance franchise with complex, diversified risks across Poland and the wider region. I want to use quantitative analysis to help management understand uncertainty, not merely report historical results. The role also fits my interest in Solvency II, capital adequacy, and stress testing. I would bring disciplined analytical thinking, strong communication, and a willingness to challenge assumptions constructively while keeping policyholder protection and long-term financial resilience central to my recommendations. While answering, connect your interest in risk management with insurance economics, PZU's scale and regional presence, analytical problem-solving, regulatory awareness, and the importance of protecting policyholders while supporting sustainable business decisions. Question 2. What are the main risks faced by an insurance group such as PZU? An insurer faces underwriting risk when claims exceed expectations, market risk from movements in rates, spreads, equities, or currencies, and credit risk from policyholders, reinsurers, or issuers. Liquidity risk matters when cash needs arise before assets can be sold efficiently. Operational, cyber, conduct, strategic, and reputational risks can also affect solvency and trust. At PZU, I would assess these risks individually and in combination, considering diversification, reinsurance, capital buffers, governance, and plausible stress scenarios. Make sure to cover underwriting, reserving, market, credit, liquidity, operational, strategic, reputational, and emerging risks, while explaining how diversification, capital, reinsurance, governance, and stress testing mitigate exposures. Question 3. Explain Solvency II and why it matters to a risk analyst. Solvency II is an EU prudential framework built around 3 pillars: quantitative capital and valuation requirements, governance and risk management, and supervisory reporting and disclosure. The solvency capital requirement measures capital needed for a severe one-year loss event, while the minimum capital requirement defines a lower intervention threshold. As a risk analyst, I would help validate inputs, explain movements in the solvency ratio, assess vulnerabilities, and connect capital results with business decisions and the ORSA. In your answer, talk about the 3 pillars: market consistent valuation, solvency capital requirement, minimum capital requirement, governance, reporting, own funds, and how risk analysis supports supervisory and management decisions. Question 4. How would you explain the difference between Solvency II and International Financial Reporting Standards 17? Solvency II and International Financial Reporting Standards 17 use different lenses. Solvency II is primarily a prudential regime designed to measure obligations, eligible own funds, and capital adequacy under stress. International Financial Reporting Standards 17 is an accounting standard explaining insurance revenue, service result, liabilities, and profit emergence for financial statement users. They can share data and assumptions, but valuation, margins, discounting, and presentation differ. I would reconcile the frameworks carefully rather than assume an international financial reporting standards movement directly equals a solvency movement. Be sure to mention that Solvency II focuses on prudential capital and market consistent solvency, while International Financial Reporting Standards 17 focuses on financial reporting, insurance service results, contractual service margin, and investor transparency. Question 5. What is the ORSA, and how would you contribute to it? The ORSA is an insurer's forward-looking assessment of its risk profile, solvency needs, and ability to remain within risk appetite under expected and adverse conditions. I would contribute by collecting reliable exposures, challenging assumptions, running stress and reverse stress scenarios, and comparing projected capital with strategic plans. I would also document management actions, data limitations, and conclusions clearly. A strong ORSA is not a compliance exercise. It informs capital allocation, underwriting strategy, and contingency planning. Focus on the forward-looking nature of the own risk and solvency assessment, business strategy, risk profile, capital planning, stress scenarios, reverse stress testing, management actions, documentation, and board-level communication. Question 6. How would you assess whether PZU's solvency ratio is robust? I would not judge robustness from the headline ratio alone. First, I would review the quality and availability of own funds, the composition of the SCR, and concentration in major risk modules. Then I would analyze sensitivities to interest rates, spreads, equity markets, claims inflation, and exchange rates. I would compare results with internal risk appetite, regulatory requirements, peer context, and projected business growth. Finally, I would assess whether management actions are realistic and executable under stress. In your answer, distinguish the reported ratio from its quality and resilience by reviewing own funds, SCR drivers, sensitivity analysis, diversification, restricted capital, management actions, regulatory buffers, and forward projections. Question 7. Describe how you would perform a stress test for an insurer. I would begin by identifying material vulnerabilities through exposure analysis and prior sensitivity results. For example, a scenario could combine a sharp rate shock, widening credit spreads, equity losses, higher claims inflation, and increased lapse rates. I would map each shock through assets, liabilities, earnings, liquidity, and capital, including correlations and management actions. I would test severity and plausibility, validate calculations, compare the stressed solvency ratio with risk appetite, and explain practical mitigants rather than simply presenting a number. Mention scenario design, material risk identification, historical and hypothetical shocks, balance sheet transmission, second-round effects, capital impact, management actions, severity, plausibility, and clear interpretation of results. Question 8. How do interest rate changes affect an insurer's balance sheet? Interest rate changes affect both sides of an insurer's balance sheet. Falling rates generally increase the present value of long-duration liabilities, while bond assets also rise in value. The net impact depends on duration matching and product guarantees. Rising rates can create asset losses, reinvestment benefits, or lapse pressure. I would examine parallel and curve-specific shocks, spread movements, hedge positions, and liquidity effects. The conclusion should focus on net economic impact, not isolated asset or liability movements. Be sure to cover asset and liability duration, market-consistent valuation, reinvestment risk, guaranteed benefits, spread effects, hedge effectiveness, accounting differences, and the importance of analyzing both parallel and non-parallel curve movements. Question 9. How would you analyze credit risk in PZU's investment portfolio? I would segment exposures by issuer, rating, sector, geography, instrument, maturity, and counterparty type. Then I would assess probability of default, loss given default, exposure at default, rating migration, spread sensitivity, and concentration against policy limits. I would review both direct investments and reinsurance recoverables, because a reinsurer's deterioration can increase net claims risk. Finally, I would run downgrade and default scenarios, identify breaches or emerging concentrations, and recommend limits, diversification, or enhanced monitoring. Discuss issuer quality, probability of default, loss given default, exposure at default, concentration, migration risk, spread risk, collateral, country and sector limits, reinsurance recoverables, and scenario analysis. Question 10. What is underwriting risk, and how would you monitor it? Underwriting risk is the possibility that premiums and reserves do not adequately cover claims and expenses. I would monitor frequency, severity, loss ratios, combined ratios, claims development, pricing changes, exposure growth, product mix, catastrophe accumulation, and claims inflation. I would compare actual experience with assumptions and investigate unfavorable trends by segment, channel, and geography. Reinsurance reduces some volatility but introduces counterparty and basis risk. The objective is to identify deteriorating profitability early enough for underwriting or pricing action. Focus on frequency, severity, pricing adequacy, claims inflation, reserving uncertainty, catastrophe exposure, portfolio mix, loss ratios, combined ratio, policy limits, reinsurance, and early warning indicators. Question 11. How would you evaluate catastrophe risk for a property insurance portfolio? I would start with accurate location, insured value, construction, occupancy, and coverage data, because poor exposure data can undermine sophisticated modeling. I would analyze geographic accumulation by peril, use catastrophe models to estimate losses across return periods, and review probable maximum loss against capital and reinsurance protection. I would challenge model assumptions with historical events and deterministic scenarios, including climate-related trends. Finally, I would assess reinstatement terms, exclusions, basis risk, and whether limits remain appropriate as exposure changes. Mention exposure data quality, geographic accumulation, peril definitions, catastrophe models, return periods, probable maximum loss, reinsurance protection, model uncertainty, climate trends, and scenario-based validation. Question 12. What is liquidity risk for an insurer, and how would you measure it? Liquidity risk is the risk that an insurer cannot meet obligations when due without unacceptable cost or forced asset sales. I would project claims, expenses, maturities, collateral calls, policy surrenders, and premium inflows across normal and stressed conditions. I would classify assets by liquidity, test market haircuts and widening spreads, and compare available liquidity with stressed cash needs. I would also review concentration, intragroup restrictions, and contingency funding actions, because a solvent balance sheet can still experience a liquidity crisis. Cover timing and amount of cash outflows, premium inflows, liquid assets, collateral calls, surrender behavior, stressed claims, asset liquidity, cash flow projections, liquidity limits, and contingency funding plans. Question 13. How would you validate a risk model or challenge its assumptions? I would validate the model in layers. First, I would check conceptual soundness, data lineage, definitions, and implementation against approved methodology. Next, I would review calibration, backtesting, sensitivity to key assumptions, benchmark comparisons, and performance across products or time periods. I would challenge correlations, tail behavior, expert judgments, and any proxy data. Material limitations should be quantified and documented, with compensating controls or capital add-ons where appropriate. Validation is successful only when users understand what the model cannot capture. In your answer, discuss conceptual soundness, data quality, calibration, backtesting, sensitivity analysis, benchmarking, stability, limitations, independent review, documentation, and whether outputs are fit for decisions. Question 14. How do you handle incomplete or inconsistent risk data? I would first define the inconsistency, identify the authoritative source, and reconcile totals to financial, actuarial, or investment records. I would apply validation checks for completeness, duplicates, dates, units, classifications, and outliers. If data remains unavailable, I would use a documented, conservative proxy based on materiality and explain its impact. I would escalate significant uncertainty, preserve an audit trail, and create a remediation owner and deadline. Reliable risk analysis requires transparency about limitations, not unsupported precision. Mention data reconciliation, source hierarchy, materiality, reasonableness checks, escalation, conservative assumptions, audit trails, remediation plans, and communicating uncertainty without delaying critical reporting. Question 15. Tell me about a time you identified a risk or control weakness. In one project, I noticed that two reports used different exposure dates, creating a material reconciliation gap. I traced the issue to a manual spreadsheet update and tested the effect on concentration metrics. I documented the evidence, informed the report owner, and proposed a controlled data extract with a reconciliation check and reviewer sign-off. The process was corrected before submission, and the new control reduced recurring exceptions. I learned to investigate discrepancies calmly and communicate risks with practical solutions. Use a concise star. Question 16. How would you respond if a business manager disagreed with your risk assessment? I would first understand which assumption or conclusion the manager disputes and distinguish factual disagreement from risk appetite judgment. I would revisit the data, show the methodology, and present sensitivities or alternative scenarios rather than relying on authority. I would acknowledge commercial objectives while explaining potential downside and applicable limits. If disagreement remained material, I would document both views and escalate through the established governance process. Independence does not require confrontation, it requires evidence, consistency, and clear accountability. Focus on listening, clarifying assumptions, separating facts from judgment, using evidence and scenarios, recognizing commercial objectives, escalating proportionately, documenting disagreement, and preserving independent risk oversight. Question 17. What risk indicators would you monitor for an insurance business? I would create a dashboard combining capital, insurance, market, credit, liquidity, and operational indicators. Core metrics would include solvency coverage, SCR drivers, combined ratio, claims frequency and severity, reserve runoff, lapse behavior, premium growth, duration mismatch, spread exposure, rating migration, liquidity coverage, and significant incidents. Each indicator needs a threshold, owner, reporting frequency, and escalation action. I would emphasize trends and interactions, because individually acceptable metrics can become concerning when deterioration occurs across several areas simultaneously. Mention solvency ratio, SCR composition, combined ratio, claims frequency and severity, lapse rates, reserve development, liquidity coverage, investment concentrations, credit migration, operational incidents, and threshold-based escalation. Question 18. How can diversification reduce risk, and when can it be misleading? Diversification can reduce aggregate volatility when exposures are not perfectly correlated, allowing an insurer to absorb risks with less capital than a simple sum of standalone requirements. However, the benefit can be overstated if correlations are poorly estimated or if businesses share common drivers such as inflation, recession, or a regional catastrophe. I would examine concentration, stressed correlations, data quality, and model sensitivity. Diversification should be treated as an evidence-based benefit, not an automatic adjustment that obscures interconnected risk. Be sure to explain correlation, aggregation benefits, concentration risk, common drivers, model dependence, stressed correlations, geographic or product diversification, and why diversification benefits require credible data and governance. Question 19. How would you prioritize risks for senior management at PZU? I would prioritize risks using impact, likelihood, speed of crystallization, persistence, interconnectedness, and proximity to risk appetite or regulatory limits. A low-probability event with severe capital and liquidity consequences may deserve more attention than a frequent but manageable issue. I would combine quantitative results with expert judgment, emerging risk analysis, and scenario evidence. For senior management, I would present the key exposure, trigger, uncertainty, proposed action, owner, and timeline. Prioritization should support decisions, not produce an unnecessarily long risk register. Discuss impact, likelihood, velocity, persistence, interconnectedness, regulatory relevance, risk appetite, controllability, scenario severity, emerging risks, and concise decision-oriented reporting with clear actions. Question 20. What would you do during your first 90 days as a risk analyst at PZU? During my first month, I would learn PZU's businesses, risk taxonomy, governance calendar, risk appetite, reporting obligations, and key systems. In the second month, I would review capital, underwriting, investment, liquidity, and operational reports, trace important data flows, and meet stakeholders in risk, finance, actuarial, investments, and business units. By day 90, I would deliver dependable recurring analysis, identify 1 or 2 practical control improvements, and present findings with clear evidence rather than proposing changes before understanding the operating context. Mention learning PZU's business and governance, understanding risk appetite, mapping data and systems, reviewing key reports, building stakeholder relationships, identifying quick wins, and delivering reliable analysis before proposing major changes. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.